All right, today is Sunday, August 2nd, and this is an earnings week preview for the week starting tomorrow, August 3rd. The majority of earnings, of course, were reported in the last 2 weeks, and the most important earnings were reported last week. And I do believe that the market made up its mind that the earnings do not justify the current valuation in the stock market. And you saw on Friday, of course, the futures reversed to the red. And even though on the heels on very blockbuster earnings from Amazon, Facebook, Apple, and Google, well, Google is kind of questionable here, but you saw the market for the most part trading in the red for the majority of the day for most sectors. Until, of course, the stampede in Apple's shares due to the stock split that took place around 2 p.m. in the afternoon. That acted as the tide that lifted all boats. And of course, because of Apple's weighting in certain ETFs and all of the indices, it has a huge weight in the Dow, S&P 500, and the NASDAQ. The stampede in Apple's share saved the market and lifted all stocks temporarily. We will see if that continues this coming week, but I believe that the market made up its mind to go to the southern direction. It was a case of Apple saving the market. We will see if this is a one-day wonder due to the stock split, or will this continue in the weeks to come. Nonetheless, this week we have some important earnings that could have implications in their respective sectors. So let's take a look here. On Monday, we have Tyson, Royal Caribbean. Royal Caribbean, of course, is questionable. I saw schedules where they're supposed to report earnings on Wednesday. Other schedules put them on Thursday. But I checked the website for Royal Caribbean, and they have a call scheduled for Monday. So I'm assuming that would be the earnings call. But we will see when will Royal Caribbean report. Just keep that in mind when you look at this slide. We also have Virgin Galactic's, aka Space, and we have Take-Two Interactive, the gaming company. On Tuesday, we have Emerson, Sony, Nikola, Activision, Twilio, Pacom, and the big kahuna for the week, Disney, in addition to Beyond Meat. Wednesday, we have CVS, Novavax, Carvana, Wayfair, Roku, and Square. And finally, on Thursday, we have Uber, Booking Holdings, Penn National Gaming, and T-Mobile. Of course, there are more names reporting, but these are the most important names in my opinion. We will cover 4 of them in details. That is Take-Two, Disney, Square, and Uber. But I will brush briefly on all the names and I will tell you what the most important thing you need to look at in these names. So when we take a look, on Monday, Tyson, of course, Tyson is very important in terms of the demand on meat, specifically poultry and pork. We have read about shortages in supply and certain COVID cases in the factories of Tyson affecting their production. We want to see if their production picked up to normal levels again, and if the demand on meat is increasing. And finally, how is the increase in prices affecting Tyson's bottom line? Are they benefiting from the increase of prices on poultry and pork? Also, keep in mind that their exports to China are very important. We want to see that number increasing. We want to see the Chinese demand recovering and picking up. Royal Caribbean is one of the big 3 in the cruises industry. The others are Norwegian and Carnival. Royal Caribbean here setting the stage for the entire industry. You of course know that they're hit very hard, but they claim that they have enough cash to flow till the end of the year. Their operations were mandated to be closed by the CDC all the way to the end of September. We're getting very close to that date, and we're not seeing recoveries in terms of the COVID situation in the country. So we must assume that the demand and the bookings for future trips are slowing down because we're not certain when will we recover and start sailing again. The most important announcement for this company is we don't want to see a further delay of operations. If they say, hey, we're going to shut down operations all the way to the end of the year to be safe, that would be a big blow to the industry as a whole. And of course, we want to see their cash operation. How are they doing in terms of liquidity? Do they need further liquidity? How long can they float with the current cash and assets they have in hand? What about Virgin Galactic? Here's a company that's very speculative, one of the Robinhood crowd's favorite, and it's been on a tear recently, not all the way to the same highs it made earlier. However, the demand on this name, buying this name, is very popular among especially young retail traders. They believe that the future for this company is very bright. Of course, the company does not have any organic revenues right now. They don't have an actual product. All they have is bookings for future trips when the service is finally formulated, which makes this company very difficult to analyze and to make assumptions, any financial assumptions, because it's a speculative name. And if we see any disappointment after the huge run and rally that space shares have seen in recent weeks, we will see the shares sell off significantly. However, any good news from the company that exceeds expectations, or if we have specific dates on trips and finalization of the service, you will see more piling on the name from the Robinhood crowd because of the fear of missing out. They want to reserve their shares. They think this company will grow significantly to 10, 20, 30, $50 billion valuation when it's finally have the service running. Take-Two is a name that we will look into in details, so I'm not going to talk about it right now, but let's look at Tuesday. Tuesday we have an industrial giant, Emerson, have global implications of the economic recovery, and we do have Sony. Sony, of course, a giant behemoth, a conglomerate with very different operations under their umbrella, but their gaming business is very important because it is the business that is growing and thriving under the current environment. We need to see specific release date and pricing on the next Sony PlayStation 5. And of course, we know that they had two major games releases this quarter. One of them is The Last of Us 2, which is a fantastic game, and Ghosts of Tsushima. We need to see the sales numbers for these particular releases. Their camera business, their chips business, and other businesses could be specifically entertainment, the movie production. That will take a hit, a massive hit. We know that. Therefore, I think the concentration here will be on the results of the gaming part of Sony. What about Nikola? Nikola is another name, high-flying name, speculative from the Robinhood crowd. However, they got a decisive blow in their head, pumping this stock. And then, of course, the Johnny-come-latelys to the pump were dumped severely and significantly. This stock is down over 50% from the highs. And of course, it was a painful ride for many of the young retail investors who piled into this name with zero knowledge of how the stock market works or zero knowledge of how valuations work. Nikola at some point was valued more than Ford Motors Company, the oldest car manufacturer in the world. Of course, Nikola doesn't have any product yet. They don't even know when they're going to release their products. They're not sure. They give you a date, but they're not really sure. All they do is reservation for their new products, the Badger and the rest of them. And the reservations mean nothing because anybody could just click the button and do a reservation. That means absolutely nothing from a financial perspective. Nikola is a painful lesson for those gamblers and risk takers who put a lot of money into this name and now they're lost big. I remember when I shorted this name back in June, I was reading the comments on different social media and other platforms just to see what the current mood about this stock is. And I can tell you from the comments, it was absolute mania saying that this company is going to be the next Tesla. It's going to be bigger than Tesla. Buy it now because hydrogen is the future. And when shares started to drop, they cling on any little hope they can find. Oh, it's the conference call. Remember the conference call? They're going to be a conference call and they're going to have some revelation there. So hold on to your shares. Wait for the Badger press release because that's what's going to push the stock back up. Don't sell right now. And of course, they keep clinging on any little thread of hope that they can find until they lose all their money. And then, of course, they hit the sell button and take the losses. That is the problem with these speculative names. And I have seen the same mania in many different names. You've seen what happened to Kodak. Kodak dropped big on Friday. And you're going to see a lot of the vaccine names dropping big too. The Robinhood mania bubble is finally being poked. And there's a lot of air coming out of the bubble. And there's a lot of pain about to come on these speculative names. What about Activision? Activision, of course, will react however Take-Two reacts. And this is why I chose to cover Take-Two instead of Activision, although Activision has more diverse and wider operation than Take-Two, which is very specific to video games consoles. And then, of course, we have after the bell Twilio. Twilio is one of those high-flying names. It went way beyond where it's supposed to be in terms of valuation. It's a growing company. It's a fantastic company. The problem here, of course, is the valuation. And you saw the CEO dumping about $9 million worth of stock recently. So this is a very risky name to stay in, Twilio. I would recommend taking your profits if you have any shares and wait after the earnings release to decide whether you want to hop back in or not. We also have Pacom. Pacom is one of the software names. We have seen recently a big bet, bearish bet against the software names. Here is a case where we have the case of the tide that lifted all boats. Some names are thriving in the software sector in this COVID lockdown work from home environment. These stocks benefited all the names in the software/cloud sector. They're all trading well above the bottom and certainly well above their highs prior to the bottom of the coronavirus crash. However, Paycom is more related to the HR business. Its main service and operation in the employee payroll services. We know a lot of employees were fired. We know a lot of companies have shut down, specifically smaller to medium companies. They don't have the same number of employees that you used to before. This is a company that bills you based on the number of employees that you have. If you have a reduction of employees, that will translate into reduction of revenue for Paycom. So we could see a case here where we have winners and losers within the software and cloud sector. Certain names deserve to be up. Other names shouldn't be up. They should be trading lower and to the southern direction. We will see that clearly after Paycom earnings report. The big kahuna, of course, is Disney. We're going to talk about Disney in detail, so I'm not going to talk about it right now. But we have Beyond Meat. I think I covered Beyond Meat last week because it was supposed to report last week. However, they delayed the release till this week, but it's the same sentiment from last week. The focus and the concentration is about the growth, the new business contracts that they have received in China. We want to see more contracts and growth in that specific avenue. And on Wednesday, we have CVS, of course. We have seen the disaster of Walgreens. Walgreens fired a lot of workers and they want to reduce their dividends. Their results were horrible. The backdrop for CVS earnings, of course, negative because of what Walgreens reported. So any surprise to the upside here in CVS, if they're not negative or abysmal as the analysts are expecting, you could see shares of CVS rallying a little bit. Here is a name, of course, very popular among the vaccine bros who are buying every vaccine stock out there, pushing the valuations to the stratosphere. Novavax. Novavax have no product. They never produced a vaccine or a product before, yet the government gave them billions of dollars so they can develop the so-called vaccine. I explained to you the corruption that's going on in the White House right now. They're giving billions and billions and billions of dollars in the so-called Operation Warp Speed to very speculative biotech and pharmaceutical companies to develop the vaccine. There is no watchdog over this operation. Of course, we're supposed to pay the companies after they develop a successful vaccine, not before. But God knows who's investing and buying these stocks before the announcements, like we saw with Kodak. Certain white-collar criminals are making a killing here, buying these names before the announcements from the White House announcing funding for these companies. Novavax, of course, up in an insane level since the announcement that they received over $1 billion in the Operation Warp Speed. The believers in this company, of course, they say, oh, they have another vaccine in the pipeline that they're developing and it had successful trials, and because of that vaccine, once it comes out in the market, they will make billions and billions and billions of revenues. Therefore, their valuation is justified. Here's a little history for you. I did work as a M&A analyst, mergers and acquisition analyst for one of the biggest biotech companies in the world. My job was to look at these smaller biotech companies with no product releases yet, only certain trials in the pipeline, and trying to put a valuation on them of how much my company should pay to acquire them. I can tell you, there is no model in the world that could justify the valuation for Novavax. The only thing that you could do is valuing the company based on their cash positioning, aka the money they received from the government in the Operation Warp Speed. That is it. We know executives are dumping stocks like there is no tomorrow, and God knows what they're going to do with this Operation Warp Speed money. Are they going to distribute it in bonuses instead of making a vaccine? They're, of course, looking for a manufacturer for the vaccine with the Fujifilm. The whole vaccine thing is very shady, and if you look at the put options on Novavax, they're absolutely insane. They're so expensive. I tried to buy some puts on Novavax. They're so expensive, it doesn't make sense to buy them at all. Basically, the market is making a bet that Novavax will crash after its earnings report. Of course, if we have seen a case of option premiums increasing both in calls and puts, like we've seen in Tesla a few weeks ago, I would have conducted a trade where I can receive credit and make money either way, whether the stock goes up, down, or nowhere at all. But because the option premiums increased in puts, not in calls, you cannot do that anymore, and you just have to be a spectator and watch the show. Here is another high-flying name, Carvana. Carvana is at all-times high. They sell used cars online with consumer spending and consumer power dwindling. We're not selling biscuits here. We're selling cars with thousands of bucks of commitment. Are consumers making these big bets and buying cars in the midst of a pandemic? Well, we know the numbers. We know the numbers in terms of used car sales, and in terms of new car sales, they're down. Certain companies like CarMax had very impressive promotions, and that increased their sales momentarily. But as we get deeper in the crisis, consumer will become more careful where they spend their money. If you have a car that's already working, why would you need another car? You're not driving to work anymore. There's absolutely no need to buy cars right now. Any disappointment in this name, any increase in their cost, we know their cost is increasing like crazy, that will crash the stock and will pull it down significantly. It's one of these names that flew really high with no justification whatsoever. What about Wayfair? Wayfair is one of the high flying names. It's up massive percentage since the bottom. I invested in this name after the reversal from the bottom, and I sold my shares in June. I made a video in that. I made a video about that, and I said that I'm selling my stocks in Wayfair because of the reopenings of IKEA stores. We need to see in the report if the reopenings in IKEA ate a little bit of the growth from Wayfair. Any disappointment to the downside will crash the stock, because this is a stock that's pricing a massive increase in revenue and customer retention, meaning that they bought last month or a few months ago and they're making reoccurring purchases from Wayfair. I have no problem missing on the last 10 to 15% of gains in the stock. I sold my stock back in June, no problem. Took my profit, because at this point, holding to this stock is just a symptom of greed. What about Roku? Roku is another name, this high-flying name, with the assumption, of course, of cord cutting and switching to streaming. We need to see if Roku is benefiting from the environment of cord cutting, if there are more subscribers. Of course, we've seen the sales of televisions picking up because people are staying at home, working from home, and they need nicer new TVs to watch their show and binge and all of that. Are they buying televisions with the Roku service already in? That will accelerate the sales and will make Roku's quarter look better than expected. But remember, this is again a high-flying name, so the results better meet the expectations, because any disappointment here will cause a sell-off. Square is a name that I'm going to cover in detail, so I'm not going to go through it right now. What about Thursday? Uber, the same story. We're going to go through it in details. Booking Holdings. We have seen the disaster of Expedia. Of course, I shorted Expedia. I didn't short Booking Holdings. The reason is Expedia depends on merchants' revenue, meaning that they make revenues directly from the customer and from the facility that you are booking in. In other words, they're dependent on customer spending and customers traveling in this pandemic, which is not going to happen. That's why we've seen Expedia revenues down about 90% year over year. On the other hand, Booking Holdings rely on the majority of their revenue from agency revenues, not merchant. Agency revenues have the tendency to be more commercial and corporate bookings. These bookings are likely to recover faster than travelers, aka individual customers' bookings. Specifically, as we see the recovery happening in other parts of the world, Booking Holdings have more footprint globally compared to Expedia, which rely on the majority of its revenue from the United States. So maybe here the expectations are so negative and dark on Booking Holdings. Any surprise to the upside in Booking could rally the stock or at least keep it stable where it is. And then we have Penn National Gaming, of course, in the casino business. We have seen Las Vegas casinos losing over 90% of their revenues year over year. Penn National is more diverse. It is not concentrated in Las Vegas. It is regional. So are they going to defy expectations? Are we going to see more revenue here in the regional gaming versus Las Vegas gaming? Either way, it doesn't matter. Penn National, of course, recovered all the losses from the coronavirus sell-off. And now it's trading, of course, at almost all-time high. You saw the stock selling off about 8% on Friday. The expectations here are very high. This stock better meet expectations or it will follow suit with what happened to Las Vegas casino names. Of course, we know that one of our favorite personalities, Dave Barstool, is one of the biggest shareholders in Penn National Gaming. So if this stock crashes, it'll be really hilarious to watch his Twitter reaction. Dave Barstool, of course, is leading this cult movement of gamblers betting on speculative stocks, creating pumps and dumps all over the place. This behavior, of course, is going to end up in tears, and it will be really hilarious to watch. Lastly, we have T-Mobile. T-Mobile is one of the growing companies in the telecom sector. It is becoming a big utility company. We have seen from AT&T results that there are certain customers that just stop paying their phone bill. Are we going to see the same thing in T-Mobile? How would that impact their bottom line? We know that unlike AT&T and Verizon, T-Mobile is more specific to telecom compared to internet providing and television. So we will see more stability in T-Mobile earnings compared to other names in the telecom sector. That is at least the expectations here. All right, let's take a look at Take-Two Interactive in details. The expectations for earnings this quarter is $1.06 compared to 27 cents for the same quarter a year ago. So they're expecting significant growth here in Take-Two's earnings. The revenue expectations is for $844 million versus $540 million for the same quarter a year ago. Again, an expectation of growth here. The stock, of course, grew 42.5% for the same quarter a year ago. A huge movement. Is it justified or not? To know that, we need to look at the net revenue and the net bookings year over year. What is the growth here? This is from last quarter. As you can see, Take-Two grew their net revenue and net bookings significantly, especially in the digital category. We need to see the growth continuing year over year, but most importantly, quarter over quarter, because we don't want to see this as a one quarter wonder where people got a stimulus money or an additional $600 a week for unemployment and they spent it on video game. And then they got bored, they bought all the games they want, and now this is cooling off. We don't want to see that. We want to see a continuation and a build-up on the growth of digital net revenue and digital net bookings for Take-Two. And of course, on Tuesday, Disney. This is the most anticipated earnings report this week. The expectations for earnings is a loss of 64 cents versus a gain of $1.35 a year ago for the same quarter. The revenue expectations is $12.4 billion versus $20.25 billion a year ago for the same quarter, a huge drop in expectation. The stock, of course, is down more than 20% since last quarter a year ago. The expectations are very dark here for Disney. I think they overdid it to the negative side. So it is, of course, to Disney's advantage that any little surprise to the upside could rally the stock significantly because the expectations are so bad to begin with. But let's take a look at the numbers and details. These are, by the way, the numbers how they reported it in last quarter's press release. Look at how ugly these charts are. I'm not talking about the numbers, I'm talking about the design. I don't understand why companies that make billions of dollars can't hire a bunch of interns to create attractive PowerPoint slides to make it more visually appealing, specifically for the new generation of investors to read these press releases. Here I took the numbers, the ratios for growth year over year for each category, and I made the slide. It took me about 5 minutes. Is this too hard to make, Disney executives? As you can see from my charts, the nice ones, for last quarter, here is the growth in each category for Disney business units. Media networks grew 28% year over year. The parks were down 10% year over year, and the studios were up 18% year over year. Of course, the direct to customers, which is Hulu, Disney Plus, is up over 360%. That is the most important category, of course. So what do we need to see this quarter? We know parks are going to be bad. So the concentration is not on parks. We know it's going to be bad. We know studios will slow down because theaters are closed. This is not the most important thing. The most important thing here is media networks. We want to see, the assumption, of course, is cord cutting. People are streaming more and they're canceling their cable subscriptions because they're too expensive to keep in the pandemic economic conditions. If we see instead that the revenue for the media networks, ABC and ESPN, increasing instead of decreasing because people are watching more cable, they're not canceling their subscriptions, and we're seeing more advertisers paying to advertise in these networks, that will be a huge surprise to the upside. But of course, keep in mind the expectations and the reality outlook for the situation that we will see media network revenue decreasing this quarter. All eyes, of course, in the direct-to-consumer category. We need to see growth in Disney Plus. We need to see growth in Hulu, not just in revenue. The revenue will come one way or the other, but we need to see more subscribers, paying subscribers. That is the most important thing right now. The margins don't matter. As long as you're gaining more paying subscribers, that is the most important thing. That could offset the disappointment in parks and in studios and even in media networks. Here is, of course, a look at the growth for Disney Plus, ESPN Plus, and Hulu. That's the direct-to-consumer, of course, category. Year over year for last quarter, they grew significantly. We need to see that growth continuing, specifically in Disney Plus. Last quarter, they had 33.5 million subscribers. We need to see the number above, well above, 40 million subscribers this quarter, and we need to see a gain in Hulu, of course. This number should exceed 30 million subscribers. Again, don't be surprised if Disney shares actually rally after the earnings because the expectations are so bad. All they need to do is deliver big numbers in their Disney Plus and Hulu subscriptions, and that will offset all the negativity about parks, studios, and media networks. Let's shift to Square. Here is, of course, a symptom of the La La Land market. Square is up 90% year over year for the same quarter. We need to see that is not just justified, but well above justification in terms of the revenues and the numbers Square will report. The earnings expectations is a loss of 5 cents compared to a gain of 21 cents a year ago, and the expectations of the revenue is a drop to 1.13 billion versus 1.17 billion from the same quarter a year ago. So if analysts are expecting the numbers shrinking year over year, why did the stock move over 90%? This is the disconnect that could actually finally connect after the earnings report, and you could see Square shares crashing significantly. But here is why the stock rallied in the first place. And maybe, of course, the piling up and the fear of missing out made that green shoot exceeds and go in the crazy territory a little bit. But the reason why the shares picked up and recovered is due to the last quarter earning, aka first quarter. They have reported a net revenue increase year over year of 44%. The expectations was, of course, that they're going to report a loss or they're going to report a decrease and deceleration of net revenue year over year because of small business closures. Square defied the expectations last quarter, reported 44% growth in net revenue year over year. Here is the second number, and perhaps the most important number you need to pay attention to. It's not total net revenue, it is the GPV, gross payment volume. Quarter over quarter, a year ago, year over year, for last quarter, the growth was about 14%. Here is what we need to see. This is what will make or break the stock. We need to see the GPV number for this quarter, the growth year over year exceeding 14%. We need to see the GPV volume accelerating again. Any deacceleration, any growth, even if it is a positive growth, but it is less than 14%, will give no justification for this stock's valuation whatsoever. And I think that we will see a significant sell-off if that number, the GPV, disappoints. That is the most important number you need to keep your eye on. Finally, let's talk about Uber. Uber has, of course, big implications on the recovery and the delivery business and all of that. Very important name to cover. The earnings expectations of a loss of 80 cents compared to $4.72 last year for the same quarter. Analysts are expecting a little bit of improvement here in earnings, of course, as Uber get more control on their costs, but we also saw the acquisition of Postmates. So how would that factor into the earnings? Did analysts miss that calculation? Did not factor in the acquisition of Postmates? We will see that, of course, in the earnings report. The revenue expectations for $2.18 billion versus $13.17 billion for the same quarter a year ago. So we're seeing an expectation of deacceleration of revenues, yet an increase and an improvement in the earnings picture. The stock, of course, moved about 29.5% for the same quarter a year ago. Here is the most important number you want to look at when Uber release their earnings report. By the way, take a look at this chart. Of course, it's a simple table format, but at least they added some colors to it, which makes it easier to read. Take a note, Disney. Take a note, Amazon. Please produce at least a little bit of visual appeal in your press releases. The most important category, this is for last quarter. Look at what happened last quarter. The rides year over year growth decreased to only 2%. So it was still positive, but it's only 2%. However, the increase in the Uber Eats category ballooned to over 53% year over year. Of course, we know what happened here and what the reason behind the growth. Things are closing, people are home, they're ordering food from Uber Eats, and they're not taking rides as they used to before. Of course, they have a freight business and other bits. I don't know what that is. Uber horses, I don't know what that is. But these are, of course, insignificant compared to rides and eats. Here is what we need to see. The expectations, of course, compared to last quarter is some states and some countries opened up restrictions of the lockdown and stay-at-home orders. How would that impact rides and eats? The assumption, of course, it will increase rides a little bit, so we need to see some positive growth year over year in rides, and the expectation, of course, that eats might go down a little bit, the growth might go down a little bit as the reopening happen and people go out to eat instead of ordering from the app. Any shrinkage in the growth from eats should be met with growth in the rides category. Otherwise, we're going to see big movements in the stock, either way, up or down. Here is the negative scenario. The negative scenario, of course, is, hey, we've seen the COVID-19 situation worsens since last quarter. So we will see the rides growth year over year actually trending negative. Furthermore, because of the increase of the COVID situation and because of the reopenings in other territories in the world where they reopened successfully, at least till now, the eats category will slow down. The growth in eats will slow down from 53% year over year to a lower number here. That would be very negative. That would crash the stock when we see deacceleration of growth in rides, deacceleration growth in eats. That will be a big problem from Uber here. The positive or the bull scenario for Uber shares here is the following. Hey, as states reopen, as other territories around the world reopen, we will see an acceleration of rides the right business will grow more positively compared to last quarter year over year. And the Eats business, the people who ordered from Eats and adapted the takeout ordering from the app will continue to do so. It will become a habit thing. It will become a routine thing. And we will see that the growth in Eats at least stays stable quarter over quarter, year over year, or grow even a little bit. That would send the shares of Uber significantly higher because we will see a recovery and a retention of the gains and the growth they have took during the lockdown. All right, we're done with covering earnings for now. Let's take a look at the economic calendar for this upcoming week. On Monday, we have the ISM Manufacturing Index. You know, this is a bullshit number. I don't really care for it. They can make up whatever number they want to make. But a lot of economists and the algos, of course, take this number very seriously. Then we have motor vehicle sales. This is very important. And perhaps you want to pay attention to that number if you're investing in Carvana, because Carvana will report their numbers later in the week. So maybe you want to take a look at this number and make an assumption and a conclusion about Carvana's earnings. Tuesday, we'll have factory orders. Wednesday, the ADP employment report and the services PMI. The services PMI is very important. Again, it's a fake number. They make it up and then it's a survey and then they revise it and it's the same story all over again. But the importance, of course, here because of the algos, we are a services economy. This is the highest growing category of our economy. Any slowdown in services here will be very negative and have very negative implications on the overall economy and in the stock market as well. Thursday, we have the weekly jobless claims. Of course, we're seeing the trending higher. If we get another confirmation here, pay attention because this week could break the market. If we trend higher again in jobless claims and we see a V-shaped recovery in jobless claims here, that would be very negative for the stock market because all the money and all the liquidity and all the stuff that they poured in, bailouts, is not doing anything to fix the employment picture in this country, or rather the unemployment picture. Lastly, of course, the big number, the most anticipated number here is the jobs report. This is the big job reports, not the ADP. We're going to have the non-farm payroll numbers and the unemployment numbers on Friday. Very important. You saw the celebration for the last number last month, and I told you that last month would be a peak. We're going to see acceleration of job losses as we continue lockdown in big states like California, Texas, and Florida. Again, Thursday and Friday could really break the market and trend us to the red or to the southern destination here in the stock market. And of course, we have the fiasco in the circus in Congress with the stimulus. They're fighting back and forth, trying to delay the whole stimulus thing. Maybe a little crash in the stock market will motivate them to come together and make a deal. So watch out for that. Crash in the stock market. Don't be surprised that immediately we have a deal with stimulus and the stock market recovers again. At least this is how I see it. But again, it's an exciting week. We have very important implications for the stock market in terms of earnings and economic data. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.